Hey everyone, and welcome to today's Explainer. We're going to be moving way past the simplistic black and white narratives you usually see in the headlines to really decode the fascinating and honestly highly complex relationship between China and Zambia. If you follow global economics even a little bit, you know this partnership gets a lot of buzz. But the reality on the ground, it's so much more nuanced than a quick soundbite can capture. So today, we're rolling up our sleeves, diving into the sources, and looking directly at the data to figure out exactly how this relationship actually functions. Let's get into it.
Okay, so here's our roadmap for the Explainer. We're going to start with decades of deep ties, move on to co-creating a debt crisis, look into the restructuring dilemma, check out Zambia's copper catalyst, uncover the human cost, and finally, wrap things up with the broader implications.
Section 1. Decades of deep ties. Building the foundation. To really grasp what's happening today, we kind of have to hit rewind and see how these two nations built their relationship over decades. I mean, this was absolutely not an overnight phenomenon. Look at this timeline. It's super interesting to see how China went from basically supporting Zambia's post-colonial political independence right into becoming this massive economic powerhouse partner. Back in the 70s, China actually financed the Tazara Railway just to help Zambia bypass the apartheid regime down south. But fast forward a couple of decades, driven by China's going out policy and the Belt and Road Initiative, and the whole relationship shifted into high-gear commercial investment. Ultimately, though, this massive financial entanglement led us right to 2020, when Zambia unfortunately became the very first African nation to default on its Eurobonds during the pandemic.
Now you might be wondering, why Zambia? What made it such a magnet for all this foreign capital to begin with? Well, look at these conditions. They hold stable, democratic elections every 5 years, and they have incredibly open markets. We're talking liberalized banking, free trade, and property rights that really protect investors. Oh, and of course, they are sitting on incredibly rich copper reserves. That's literally the essential metal powering the smartphone or computer you're probably watching this on right now. It's basically the perfect storm for foreign capital.
Section 2. Co-creating a debt crisis, a shared responsibility.
So that massive rush of investment, it eventually spiraled into a really severe sovereign debt crisis. And when we actually dig into the research, it turns out both nations really share the responsibility for how it all fell apart. Get this. Independent research estimates that Zambia's debt to Chinese lenders alone is sitting at an unbelievable $6.6 billion. That is almost twice the amount reported in official Zambian records. Crazy, right? This huge gap is mostly due to super strict confidentiality clauses that keep the public from knowing the loan terms, or sometimes from even knowing the loans exist at all.
To understand how the debt got so out of control, researchers point to something called the tragedy of the commons. Imagine a shared fishing pond where everyone just catches as many fish as they want, and there are absolutely zero rules to stop them from taking too much. In this situation, Zambia's public resources and credit were basically overfished. On one side, Zambian politicians were totally bypassing their own borrowing rules to fund politically popular projects. And on the other side, you had this really fragmented group of Chinese lenders fiercely competing with each other, completely lacking any top-down coordination from Beijing to put the brakes on all this unsustainable lending.
And to make it all even messier, we have to talk about moral hazard. Think about it. Historically, Zambia has been bailed out by the Paris Club of Western creditors and by China a lot, like way more than almost any other African nation. And according to the sources, this constant safety net created a severe moral hazard. It essentially encouraged Zambian leaders to completely brush off the devastating risks of a default, mostly because they just assumed someone would eventually bail them out again.
Section 3. The restructuring dilemma. 2 different playbooks.
So the default actually happens in 2020. But fixing it? That proved to be an absolute nightmare. Why? Because the traditional global financial system completely clashed with China's unique lending playbook. Normally, debt restructuring relies on the Paris Club, a very coordinated, transparent, and rules-based group of creditors. But take a look at China's approach over here. It's historically highly bilateral, fragmented across dozens of different banks, and, as we mentioned, notoriously secretive about its terms. Trying to get these two totally different systems to agree on how to restructure Zambia's immense debt was a monumental standoff.
Despite those huge differences, though, there was a massive breakthrough. In June 2023, Beijing actually showed a very pragmatic interest in stabilizing the global economy. They agreed to co-chair Zambia's restructuring committee right alongside France. And wow, this marked a historic, real game-changer of a shift for China, moving toward actual cooperation with traditional Western creditors and frameworks.
Section 4. Zambia's copper catalyst, ground zero for investment.
Let's zoom in a bit from all those high-level debt negotiations and look at the actual lifeblood of this relationship, Zambia's world-famous copper industry. Just look at the glaring disparity in this data, with 18 distinct Chinese lenders and 27 different contractors operating inside the country. Zambia is a huge outlier. I mean, compare that to Angola or the rest of the African continent, which averages under 5 lenders. Zambia is literally ground zero for Chinese financial engagement in Africa. And all those billions in loans? They aren't just numbers on a screen. They physically manifest as these massive, sprawling complexes. For example, the China Non-Ferrous Metals Mining Corporation, which is overseen directly by the Chinese government, operates 4 major mining and smelting facilities right in Zambia. And together, these operations provide over 6,000 local jobs, literally breathing new life into mining towns that had basically been sitting dormant for over a decade.
Section 5. The human cost, realities underground. But as we zoom all the way down to the micro level, down to the everyday human experience of the Zambian miners, it reveals a completely startling contrast to all that shiny new infrastructure up above. Read this quote, "You'll be fired if you refuse." It's absolutely chilling. This comes straight from a Human Rights Watch report investigating these state-owned mines. Zambian miners are routinely being forced to work in totally hazardous, unsupported blast sites, all under the strict threat of losing their livelihoods if they dare to complain or refuse to enter an unsafe area.
The stark reality here is that, yes, essential jobs are certainly being created, but the workers are paying an incredibly steep price. We're talking grueling 12-hour shifts that balloon into 78-hour work weeks. Miners are exposed to acid and rock falls, and managers are reportedly flat-out refusing to replace damaged protective gear. And it gets worse. Poor ventilation is causing severe, irreversible lung diseases like silicosis among the workforce. On top of all that, the reports detail illegal union-busting activities that violate both Zambian and international labor laws, actively suppressing the historically powerful Mine Workers Union of Zambia. Which naturally brings us to the elephant in the room. Zambia actually has incredibly robust mining regulations already on the books. So in a country with a proud, historically strong mining union culture, why on earth are these unsafe conditions and blatant labor abuses allowed to just continue unchecked?
Well, according to our sources, the answer lies in a critically weak regulatory system. The Zambian Mine Safety Department is practically paralyzed right now. Thanks to hiring freezes, only 13 of their 28 inspector positions are actually filled. The whole department is severely underfunded, occasionally faces allegations of corruption, and the safety fines they do levy, they are just way too small to actually deter these massive corporate entities. Ultimately, there's just been a total inability, or maybe an unwillingness, to aggressively challenge the super lucrative special relationship between the Zambian government and their vital Chinese investors.
So I want to leave you with this final crucial thought. What's happening in Zambia right now is a profound case study for the rest of the world. As China's economic footprint continues to expand across the global south with these massive infrastructure and mining projects, a central tension remains. Will Chinese state-owned enterprises ultimately adapt to established international labor and debt standards, or will developing nations just have to adapt to China's? Understanding this dynamic is absolutely essential if you want to understand the future of the global economy. Thank you so much for joining me for this explainer, and remember, always keep questioning the simple narratives.